Hello everyone. In this recording we are going to take a look at the Chapter 8 lecture. I have to be honest with you, Chapter 8 is pretty much a continuation of Chapter 7 where we're talking about variances. And once again, we are talking about breaking up the flexible budget variance into two smaller amounts. This is the level 3 analysis that we talked about in Chapter 7. And in Chapter 7, we were concentrating on the manufacturing cost for materials and labor. And in this chapter, we're going to talk about the last manufacturing cost, which is the overhead. And got to be honest with you, the formulas are pretty much exactly the same format as we saw in Chapter 7. Honestly, I think Chapter 7 and 8 could have been combined into one chapter. It's pretty straightforward in regard to that. And so once again, before we get into the level 3 analysis, let's just talk about the overall budget variance, which is the level 2 analysis that we talked about. And as you see on this slide here, the overall flex budget variance is the difference between the actual cost incurred and the flex budget amount. Now remember what the flex budget amount is. The flex budget amount is the budget. Remember what the budget is: the standard, the normal, what was expected, but flexed to the actual level of activity. As an example, we could have put together a static budget where we were going to produce 2,000 units of our item, whatever that is. But if in actuality we produced and sold not 2,000 units but 2,100 units, we are going to flex the budget or change the budget for 2,100 units. What would have the revenues and costs have been for 2,100 units? Okay. Now, the flex budget variance for overhead can be broken down into two smaller pieces. This is the level 3 analysis. And those two smaller pieces are called the spending variance and the efficiency variance. The spending variance for overhead is very similar to the rate variance, is what we called it, or the price variance, I should say, for materials. And then, of course, we have the efficiency variance for overhead, just like we had also for the materials and the labor. So that is the same word, but instead of using price variance, we tend to use the word spending variance when we're talking about overhead. Okay, so here's the formula, and once again it follows the same format as the last chapter. Basically what we're going to do for the efficiency variance, what we're trying to find out with the efficiency variance is what is the difference in quantities. So what we will do is, you can see the formula here, we're going to take the actual quantity of variable overhead for the actual output minus the budgeted quantity for the variable overhead for that actual level of activity. What is allowable for that actual level of activity? So the actual quantity minus the standard quantity, if you will. All right, so the difference in the quantity multiplied by the actual rate, okay? Or I should say the standard rate. Excuse me, the standard rate. What is the rate or the cost per unit? Okay, so really the efficiency variance, once again, is measuring the differences in quantities. The actual quantity used minus the amount budgeted for or allowable for that level of activity, multiplied by the standard cost. That'll give you the efficiency variance. On the other side, the spending variance is where we're looking at the differences in costs or rates. Okay, so you can see here the formula. We have the actual overhead rate or cost per unit minus the budgeted rate for that level of activity. All right, times the actual quantities. All right, so we're looking at the differences in rates. That's the spending variance. So the spending variance and the efficiency variance are breaking up the overall flex budget variance for overhead. Once again, I know I sound like a broken record, but this is following the same format as what we looked at in the prior chapter when we looked at our detailed level 3 analysis for the materials and the labor. Okay, so the journal entries that you would find, first, when we are incurring actual overhead, we would debit this account called variable overhead control, and we're going to credit accounts payable and the like, because we have to pay our vendors. And then what we will do when we apply or allocate, all right, the overhead using our predetermined overhead rates, all right, all based on standards, just like we talked about. When we allocate or apply the overhead to the WIP account, journal entry 2, we're going to debit the work in process. Once again, that's an inventory account. And we will credit the variable overhead allocated. So those journal entries are recorded every time we enter into actual overhead, number 1, journal entry 1, and when we apply the overhead or allocate the overhead, journal entry 2. And based on those variances that we just calculated in the prior slides, those overhead efficiency variances and spending variances, they will be closed out with a debit or credit, whatever is needed. All right, or I shouldn't say closed out, but they should be recorded, whatever is needed, debit or credit. And remember, debits basically are variances that make operating income decrease. Credits to the variance account are the variances that make the operating income increase. All right, and the variable overhead, basically what we're going to do is we will close that out. We will close out the variable overhead allocated with a debit, and we will close out the variable overhead control as well. So you can see that we have that here. And hopefully the variances are small that we can close out at the end of the period. Close them out to 0, whatever is needed, debit or credit, and close them out to cost of goods sold. Okay, so here's that 3-column approach that we were talking about. So we can take a look at the level 3 analysis, which you can see is breaking up the overall flexible budget variance into the 2 pieces. Over in the far left-hand column, we have, because we're dealing with overhead here, so we've got our actual quantities times our actual rates. So this is what it actually incurred. We actually incurred $130,500. And that's the amount that would be recorded as the debit, basically to the variable overhead account, as we talked about. Way over to the right, in the right-hand column, this is our budget, our flexible budget, what's allowable for this level of activity. So we're talking about our standard quantity and our standard rate. Well, the standards are basically we are allowing 0.4 hours per unit. And if we're making 10,000 units, that's the actual level of activity. We're allowing 4,000 hours. And the standard rate for our overhead, the predetermined overhead rate, is $30 an hour. So $120,000 is what we should have been spending on overhead, and we actually spent $130,500. That's an overall unfavorable flexible budget variance of $10,500. That was the level 2 analysis. And the level 3 analysis is breaking up that $10,500 unfavorable variance into 2 smaller pieces. And what you can see, in order to do that, we're going to throw in this middle column, column 2, where we're going to steal the actual quantities from column 1. In this example, the actual quantity is 4,500 hours. And we're going to steal the standard rate from column 3. And as you can see, the standard rate is $30 an hour. And then when we compare column 1 to column 2, and we look at the formulas, once again, column 1 is the actual quantity times the actual rate. Column 2 is the actual quantity times the standard rate. The difference between column 1 and 2 is not the quantities. The quantities are the same. It's the rate. This would be the rate or the spending variance. Using the actual rate, it came in lower than using the standard. That's a favorable variance. And then comparing column 2 to column 3, with column 2 we've got actual quantity times the standard rate. And in column 3 we have the standard quantity times the standard rate. The standard quantity times the standard rate. The difference is not in the rate is the same, but what's different is in the quantity. All right, and so using actual quantity, it came in much higher than using the standard quantity. That is an unfavorable, and it's called an efficiency variance. We were inefficient with our time. We were supposed to spend 4,000 hours, right, on this level of activity. We spent 4,500. We were way over where we should have been. We were inefficient with our time. That is why it's an unfavorable efficiency variance. So once again, it's very, very similar as what we talked about in the prior chapter. Now, that was for variable overhead. We could do something similar to fixed overhead. Okay, let me see here. So here are the formula. Here are the journal entries. When we enter into actual fixed overhead, we will debit the fixed overhead control account and credit all the payables and whatnot, whoever we need to pay. And then when we apply the fixed overhead to the WIP account, you have journal entry 2 here. We're going to debit the WIP inventory account and we will credit the fixed overhead. That is when we apply or allocate the fixed overhead to the inventory. All right, and then of course we will, the fixed overhead that we allocate, remember we recorded it with credits, so we will close it out with a debit. And the fixed overhead control, which we debited, these are the actuals, we'll close it out with a credit. And then the spending variance and production volume variance, those are the two variances for fixed overhead. They will be closed out as well, whatever is needed. Or they're recorded first and then they're closed out. Hopefully they're immaterial and they're just closed out to cost of goods sold. Okay, so here what we have with the fixed overhead, you can see column 1, actual overhead. Remember, fixed means the total, regardless of activity. We actually incurred $285,000, but according to our according to our budget, really our static budget, is $276,000. We spent $9,000 more than what we were expecting. That's an unfavorable spending variance. And that's the same as the flex budget variance, by the way, the $9,000. Now, fixed overhead, we go one step further, and that is basically, and interesting enough, fixed overhead, I know it's a set amount regardless of activity, but we do want to consider what's known as a production volume variance, meaning our volume was higher or lower based on the actual static budget versus what actually happened, if there's a big difference there. So we want to consider this production volume variance. And once again, the standard allowed for our level of activity, 10,000 units. We should have spent 4,000 hours, and our budget for overhead for this level of activity should have been $57.50 per hour. $57.50 per hour. All right, so for this level of activity, you can see we should have spent $230,000, but our budget in the static budget was $276,000. So the budget was a lot higher than what is allowable for this level of activity. In any event, this is called a production volume variance, and this is a nice graph of looking at the variable overhead, which is at the top. You can see we've got column, this is actually a better slide. If you really want something to zone in on to sum up this entire chapter, this is the slide to be on. You can see at the top we've got our 4 columns, which really we just concentrated on the column 1, 2, and 3. You can see column 4 is the same as 3 when we're dealing with variable overhead, where we've got our spending and efficiency variance breaking up the flex budget variance. And with the fixed overhead, we really only have a spending variance. We never have an efficiency variance. That's why you see never a variance here. It's never an efficiency variance. But we have what's known as a production volume variance. We want to take it one step further. Okay? So that's the deal with variable overhead and fixed overhead. And here's a summary of chapters, the last two chapters combined. And you can see we're breaking down our materials variance between price and efficiency variance down here. We're breaking up our labor variance between price and efficiency. These were all last chapter. And the variable and the fixed overhead. So basically we have these three here. This was considered in the current chapter. The variable overhead spending and efficiency variance, and then our fixed overhead spending variance as well. So that's something to keep in mind as we go through this analysis.